Today's topic is pandemics, climate change, recession, oh my, how to manage commercial credit risk in an ever-changing landscape. Joining us today are three former regulators from the OCC, the Federal Reserve, and the FDIC to discuss what the challenge of climate change means to you and your institution. Joining us are Jeremiah Norton, formerly of the FDIC, Bruce Richards, formerly of the Federal Reserve Bank of New York, and Mark Levonian, formerly of the OCC. All of our guests are currently advisors with Oak North. Now, before we start, know that this is an interactive presentation and we welcome your questions and comments. Please use the Ask a Question button at the bottom of your screen and we'll take up your questions and comments towards the end of our session. So with that, we've got quite a bit to cover, so let's go ahead and get started. Gentlemen, thank you for joining us today.
Glad to be here, David.
Very, very glad to have you. Let's go ahead and start right up at the top. What are some of the things that the Fed and other agencies are doing to help banks deal with this issue of commercial credit risk in an ever-changing landscape? And what are they likely to be doing in the future? And that's Bruce, if you could start with that, please.
Sure, be glad to, David. Thank you. Obviously, we've seen a lot of activity in Europe, both from the European Central Bank and the Bank of England related to climate risks and their desire to run thematic scenario tests during the course of this year. Everything from freak weather events to transitional risks that their portfolios may face. While European regulators have led the way so far, my view is that the U.S. regulators will catch up quickly and perhaps leapfrog what is actually taking place in Europe so far. We've seen action at each of the significant regulatory agencies with the appointments of senior individuals to lead committees or task forces focused on how to evaluate climate risk within the supervisory process. The Fed, as you've seen, appointed a special committee within supervision, the Supervision Climate Committee, led by Kevin Styro, who previously led supervision at the Federal Reserve Bank of New York. I would also note that Kevin is co-chairing the Basel subcommittee on climate as well. And in a speech he gave a few months ago, noted that their basic research through the Basel committee should be complete by mid-year of 2021, following which they will evaluate to what extent climate risk should be incorporated into supervisory activities and requirements. So I would note here, given that Kevin is chairing and co-chairing those two committees, that I would expect pretty full alignment between what the Fed does and what the Basel requirements are. So in addition to watching what comes out of the Fed, I would also stay abreast of what commentary you see from the Basel committee, because that may foreshadow the Fed's reaction as well.
So a couple of things for folks to keep an eye on in terms of markers in progress. So in terms of the sort of the direction that things are going, probably not a great deal of surprise that they're maybe a little bit more advanced in Europe than in the United States, but you have a fairly high degree of confidence that the United States is coming along at a pace that's satisfactory in your opinion?
Yeah, can I pick up on that one? Because I think you know, as Bruce mentioned, that it has been really interesting to hear that this has been an area where the EU and the UK have really been leading the way. Obviously, Basel Committee and the FSB have done a lot of coordinating. That's what you would expect on a major issue like this. And I think, as Bruce mentioned, you get kind of an interlocking directorate effect where you have you know, some of the senior leaders who are working together at the Basel and FSB level, then also taking a leading role at the national level. So we do get that kind of alignment. I do see the U.S., you know, moving pretty aggressively to catch up. Not that they're that far behind. I think, you know, part of that is we have a new administration that's made this a priority. And while most of the agencies are not directly, you know, under the administration, they certainly recognize those priorities, and they, I think, at this point share them. You know, I was an OCC official for many years, and that the agency acts relatively independently. The new acting comptroller has come over from the Federal Reserve, and I think, while he is certainly not going to be doing anything like taking direction from Jay Powell or Randy Quarles on things. He'll be his own man and run that agency. But I think it's pretty likely that there might be more alignment between, say, the OCC and the Fed in how they approach these things, given that there's that kind of overlap. If I could, David, I just maybe to mention one other thing. We're talking about regulators. There's still the potential for some sort of legislation. And I don't put a high priority on it, given the direction things are going, but there was a bill introduced in the last Congress, and it's been reintroduced in this one, that would direct regulators to take particular actions when it comes to climate risk in terms of particular kinds of stress testing that should be done around climate risk. Like I said, so I'm not a legislation expert. I've been wrong before, but I see those as, it's probably being less likely now, given the direction that that the administration has gone and that the agencies are going. And then maybe finally one other piece is the Treasury and FSOC, where that's FSOC, Financial Stability Oversight Council. And in there, I think the executive order directed Treasury through FSOC to take a coordinating role, which is what they were doing anyway. They've already been talking about climate at FSOC. So I think we can look for more of that too.
Mm-hmm. Mm-hmm. Yeah, I was just going to add on that point, Mark, that the executive order the president issued in May gives a 6-month timeline for FSOC to come back with a report. And I think the importance to banks in that is that, all the 3 federal banking agencies are members of FSOC. You also bring in the SEC and CFTC. So there is a real centralized coordination going on through this executive order. And so if we look for a report to come around the time of Thanksgiving, I think a logical step would be that the banking agencies will follow in some sort, either through rulemaking or guidance, to further flesh out the U.S. priorities and the supervisory priorities in this area. So I think, as Bruce and Mark mentioned, the U.S. is picking up steam at a fast pace in this area, and there'll be a lot of developments, not only in this year, but in 2022.
Very interesting. It's something to look out for. It's always interesting when we look particularly at regulations and financial services, the differences between the EU, the Eurozone, and the United States, given their different institutions, the regulatory structure being so dominant in the EU. And here, as you mentioned, Mark, the sort of competing at times pressures of the regulatory agencies as well as legislative forces that may come into play. So we've talked a little bit about regulators. We've talked a little bit about legislation in the case of the United States. Let's talk about the banks. In terms of some of the things that they are thinking about or should be thinking about, I know a lot of folks are familiar with some of the modest initiatives on tracing carbon for bank employees and things like that, or bank customers. Things have happened. But in terms of these really large-scale issues, in terms of banks addressing them, what are some of the things that banks should be thinking about or are thinking about? Maybe, Jeremiah, we could turn to you to start with this.
Well, sure. So what I've found helpful to dimension this topic is really there are 2 buckets. How does your business impact climate change, and how does climate change impact your business? Mm-hmm. And taking the latter question, of course, the materiality of climate change will be different from firm to firm, and it'll be dependent upon the risk that a particular bank takes. But if we look at the real 2 categories of physical risk and transition risk, where, of course, physical risk is the risk that changes in climate would have on financial assets, there are kind of 2 sources: the acute risk, so severe weather changes, hurricanes, floods, droughts, et cetera, and then the chronic risk, which would be changes of sea level or rainfall over time, and then the transition risk, which is the risk that actions taken to address climate change, how they impact financial assets. That can come from a policy change like a carbon tax, technology disruption. Think of EV vehicles, markets, consumer preferences, or reputation from investment pressure on financing particular assets. So I think banks have to think about those dimensions, and then think about how we're going to identify those risks and measure them. I think that's really the start for financial institutions. Dimensioning the risks, identifying them, measuring them are the key ingredients to addressing this emerging issue here in the States.
Absolutely. Bruce?
Yeah, I agree with you, Jeremiah. And I think there's an expectation that senior management and boards need to track this very closely, both looking at risks that exist within their current portfolio, what types of risks they want to take on in the future, but also on the opportunity side, to look at clients that have to go through a transition period, and how can the bank provide advice and services and financing that may facilitate that. So I think it's as always a two-edged sword. There are risks and challenges, but there are also significant business opportunities for those banks that are on the front foot, going to their clients and talking about client-related risks, whether they be physical or transitional.
Excellent. I have to admit that as I listen to this, in some respects, I think of the conversation on digital transformation and how, in many respects, this is a similar conversation writ 10 times larger, just in terms of the breadth of things that banks have to and other financial institutions have to think about, as well as the unintended consequences of those things, both in the short and long term. It's really quite a moment for financial institutions. I wonder, Mark, in terms of these risks, we know banks deal with risks all the time. That's in large part why we have them. What's different about the risks in terms of climate change? Jeremiah indicated a couple of different ways of looking at that, the impact of climate on the bank, the opposite, going the other direction, and then, some of those policy changes that might cause some, if not unintended consequences, maybe some not planned for fully consequences. I'm wondering if maybe you could address this just a little bit.
Yeah, no, I think that's a really interesting area, David. Thanks. I think, it's really big and it's really complicated. Those are good places to start. But maybe to step back a second, and actually connect the dots here back to our regulatory discussion. One of the themes that has been coming from the regulators is to think about the climate issues not as a new category of risk, but in terms of how it plays through the traditional areas that banks have identified, like credit risk, market risk, operational risk, and probably liquidity as well. So I think that's the way globally regulators are starting to think about it, that climate affects all of those. And that's probably the way banks should be thinking about it now too. I think it's sensible, and I think it would align well with the regulatory expectations. So then the issue is to think through, for any bank, think through how climate affects each of those types of risk. And banks have probably done a lot more thinking about credit risk so far, maybe a little bit about market. But I think that's the direction they need to go. So then if you put it like that, if they should be thinking about those risks, then that starts to head in some particular directions. And I think what banks will run into right away is the need for data, different and better data than what they have, probably much more granular, so that they can look at effects at the counterparty and exposure level. And maybe some different types of data than the ones that they've traditionally had to look at risk, because, who was thinking about, some of the carbon footprint variables that are now being disclosed and bringing those in. But I think, reflecting your question, right, what's so hard about this, again, is that it's complicated. We know temperature matters, emissions, economic activity, energy use, land use, all these things are all going to interact. And to really do a thorough job in this, all of those complex interactions have to be considered. Infrastructure could deteriorate, prices will be changing. So that's what's hard. And then the follow on from that is, just to wrap it up, is regulators, I think, will acknowledge that it's hard, and they'll look for banks to acknowledge the uncertainty that follows from that in what they do. So in formulating risk management and formulating business strategies, they should reflect the uncertainty around these kinds of climate-related changes. Banks should be doing the best job they can, but not placing more weight on it than that's actually warranted from the quality of the analysis that can be done, if that makes sense.
Yeah, I would add one other risk that banks need to be attuned to in relation to climate, and that's reputational risk. Certainly a number of banks, particularly some in Europe and one in Switzerland that I'm affiliated with, have faced demonstrators literally barricading branches due to the financing of a pipeline in North America. I mean, this is a global reach for activists, and I think public opinion is something that we can touch on later, but it's critical in terms of how a bank is perceived within its broadest community, as you would define it. And I think the other aspect that I would highlight is the due diligence around clients, both looking at their risk, but in the selection of clients. Some banks are taking a view of their existing portfolio as they look at the risks and opportunities related to climate and ranking their clients along a risk spectrum. One notable example I'm familiar with is a bank looking at their clients who obviously have huge climate challenges. Let's take energy companies, and saying on the broad spectrum of green to brown, where does this company fall? And more importantly, what steps are they taking to move towards the greener end of that spectrum? Does the plan make sense? And if a company doesn't have a plan, it's a pretty harsh conversation with that bank to say, you need a plan, and if you don't come up with one that we think you can execute, don't count us in the future.
Wow.
At the other end, clients that are moving forward quickly, the banks are there to say, how can we help you get there?
I think that's, Bruce, I think that's great mentioning that, because, it's easy to start thinking about this as just a negative situation with all negatives, that it's just all risks. But, there are opportunities here. I think, David, you mentioned the connection to, some of the digital transformation activity that's going on. It's not just risk. It's also that there are opportunities there for banks to be effective in supporting change and even profiting from it.
Absolutely.
We haven't talked much about scenario analysis yet, but I think that's kind of been in the background of what we're talking about. We talked about some of the regulatory exercises, but I think that's the other thing that banks should be thinking about. The direction of travel for regulators has been towards scenario analysis as a tool, which in my view it's appropriate. And I would just distinguish between that and stress testing. Although sometimes they're discussed the same way, the issue here is to create scenarios that are informative about what could happen in the future, rather than to decide whether a bank can live or die. And that approach of creating scenarios, different climate scenarios, different amounts of, whether it's the carbon concentrations, the temperature rise, and all the knock-on effects of that. That's the direction regulators have been going, and that's what banks should be preparing for. They should be thinking about how to do scenario analysis in a meaningful way, not to decide whether capital is adequate, because I don't think that's what regulators are going to be doing. I think what they want to do is use this as the lever to create a conversation, a dialogue, both within institutions and then between banks and various stakeholders, including but not limited to regulators, about what the exposures are and what different paths would mean and what could be done. All of that can be worked through scenario analysis. And that's actually, that's the most important thing that can be done right now, is to be having those kinds of conversations. They lead to risk management activities. They lead to strategic changes. They could inform and influence public policy changes that could be really crucial. So by far, that's probably the most important things banks can be doing. That was why I started talking about data, because that's what we need to improve in order to support good scenario analysis. But it's something important to be working on right now, I think.
Absolutely. And if we could, I'd like to follow up a little bit on that question of data, maybe just a slight broadening of it in terms of, do banks have what they need in order to do these things, to do these sort of analyses, whether it's with regard to the data? Are they in the position to have the full conversation with those problematic carbon companies, so they're able to have a conversation that is constructive, as opposed to one that is, we really need you to do something and we're not sure if we can help you get there, but we need you to do it from our point of view? Are those resources available to banks, in your opinion?
Well, I certainly look to Bruce and Jeremiah to speak to that too. My sense is it's the answer is it's early. that some of the data are there, but it has to be filled in. Just to take an example, there's a lot more disclosure going on now for carbon emissions of various sorts, either direct or indirect. The disclosure is getting more and more complete. It's going to be very useful to use that information, but it's not complete yet, and we don't have a lot of history. So it's directionally, that's the kind of thing banks are going to need, but it's going to have to evolve as the data improves, and then banks will be able to have more evidence-based and analysis-based conversations with, whether it's with clients, customers, counterparties, or other stakeholders. I don't know, Bruce, Jeremiah, how you're thinking about these things.
Bruce, I'll jump in here. I think that, as Mark pointed out, it is a challenge. The data is there in some cases. In some cases, it's not. The taxonomy is not defined consistently across a bank, or much less the industry. And so I think that there is both a challenge and an opportunity with data coming here. And if you just step back for a second, if we stipulate and agree that there is a policy sea change where this topic is important, not just in Brussels and London, but in Washington now, this is coming. And so policy is going to be developed at the Treasury Department, at the banking agencies. And I think a key question that I have for banks is, do you want to be solely on the receiving end of that? Or do you want to participate in it early? Do you want to try to drive the direction? Bruce and Mark can certainly speak to their experience, but in an agency, sometimes a policy department develops something and it may not be workable, and that can be quite painful for the actual examiners on the field and for the banks themselves if they're trying to fit the square peg round hole problem. And so I think banks that are more aggressive in trying to develop taxonomies and trying to mine the data they have or develop data in a way that works for them will have a good feedback loop into the policy process. So there's a risk in waiting on the supervisory side. I also think there's, as Bruce mentioned, a risk not just to supervisors, but to constituencies, whether it's investors, clients, or employees, to not being able to produce data. So people are setting goals, but how are they measuring those goals? How are they complying with those goals? Those questions are not just going to come from bank examiners. I think they're going to come from all constituencies for banks.
Yeah. I think that's a great point, Jeremiah, on banks being able to influence the policy development. I'm sure, have each seen it at our respective former agencies where something sounds great in the ivory tower of the OCC or the Fed or the FDIC, but it's not very practical sometimes for the banks to act upon. So I think leading is important in terms of policy, but also taking actions now, I think it's critical for all banks, even though there isn't guidance out there. We've all lived through this in the private sector where policy decisions are under discussion for a long period of time. Banks know what's coming, but they sit and wait. And the regulators, once they finally impose guidance or regulatory requirements, expected to be done yesterday in many cases. So I think both in terms of influencing policy, but also positioning well for future supervision, banks really do need to act now.
Yeah, I think that's a really excellent point, and maybe a point we can move to next. I just want to remind our attendees that we are taking your questions and comments, insights. If you have any to share with us, feel free. We'll take those up toward the end of our conversation. We're sort of near the halfway mark, so there's still plenty of time. If you've got a question that you're trying to put together in your head, go ahead and just hit that Ask a Question button, send it to us, and then we'll reserve a little bit of time toward the end, and we'll take up any of the questions or comments that you might have to any of our guests. Also, if you have a specific question to any of our guests, you can go ahead and indicate that as well. Otherwise, we'll just kind of keep it wide open and let all of our guests have an opportunity to take a crack at the question. But as we were headed right a second ago, looking at what banks can be doing right now, I thought that was a fantastic point about the capacity of institutions to play a part in a transformation that will be very much putting them at the center of it, and not waiting for the regulations to hit them and then trying to react after the fact. I'm wondering maybe if we could talk just a little bit about that in terms of some of the things that banks, other financial institutions can do or are doing right now to sort of shape what policy might eventually befall them. And maybe, Mark, we could start with you.
Okay. I come from a quant background. That was what I did both at the Fed and the OCC. I was involved with all the quantitative stuff. So that's why I naturally go to talking about we've got to have better data. We've got to do better with the modeling. But I think, there are a lot of other things that don't have to wait for that we know that regulators care about. And I would say, on that list is our governance processes, risk management, disclosure, and in combination with the analytics, those are the kinds of things that should matter. And so yes, it's important to keep going with the analytics, but there are a lot of things that banks can be doing just to clarify roles and responsibilities. For example, on the governance side, start factoring climate into risk appetite. Make sure that risk management processes appropriately reflect this source of risk, and so all of those are things that don't need to wait. I don't know, Bruce and Jeremiah, if those things resonate with you, but those are things that occur to me.
Yeah, particularly around the governance side. I think this is an area where executive management and the board of directors of banks needs to take a very active role in setting a direction. And institutions are going to differ in terms of their strategy, client selection, and risk appetite. And it's hard without consistency of data yet. But I think some of those policy and strategic decisions boards are working on now and will have to continue to do so. And it's, as Jeremiah touched on earlier, this isn't just because regulators are going to force it. I think it's critical for the survival of those banks to pursue it aggressively because they need to face off against investors. Employees more and more want to work for a bank that's attuned to these issues. And there are activists in the community that are going to expect certain behavioral patterns going forward. So the force of public opinion and shareholders and employees and clients, I think, are all going to factor in the need for boards to take a firm stance. And then, as Mark has touched on, develop the data that enables a board or a management team to actually monitor and track progress on certain strategic issues. One other factor I would put in here is that as an industry, we need to train people how to consider these risks and opportunities. And that's across, in my mind, all three lines of defense. Perhaps most importantly, in the first line of defense, those individuals who are originating business and managing client relationships, so that they have a clear sense of the strategy and then how to implement that strategy as they're dealing with clients.
Excellent. Jeremiah, could you touch on that also? Mm-hmm.
Sorry, go ahead, David.
No, I was going to ask you if you could touch on that, actually.
Yeah, just adding briefly to Bruce and Mark, banks do make these decisions today. There's historically it's been through more reputation than data, in the sense of, we don't want to finance a certain sector of an industry. I think one of the first that jumps out in my mind is a number of years ago, certain coal mining, right, was sort of put on no lending lists or no financing lists for some banks. And you've seen this happen, but what I don't think is as prevalent is the measurement of it. And so I think, as Bruce mentioned, boards are going to have to come up with mission statements, and the management teams are going to have to help mine that data, formulate that data, so that boards can then hold management to account. Shareholders can hold boards to account, et cetera. But I think that's really how this has to go. But it's really not a new phenomenon that banks are just making up and deciding now we're going to make a determination we'll care about climate. I think they have been in areas. I think we're going to see it more expansive across industries. And also, transition risk is not just a risk to financial assets, but it's a risk to society. So there are some companies that will need to be transitioned, and I think banks can help play a key role in determining, what are critical industries, how can we help them finance their way to a place where they're contributing less carbon output, and that's an offensive way to help the greening solution. But I don't think it's just not lending to certain people; it's lending in different ways to clients and customers.
Absolutely. One thing that comes to mind as I think about this, and again, it can't help but echo to some degree the digital transformation conversations that we've been having so much of lately, is the range of financial institutions that have to deal with this problem seems exceptionally broad, just as in digital transformations. And there's different capabilities of different type of institutions. And I guess that's one of the things I'm a little bit curious about. I know a lot of people who attend our events are affiliated with smaller regional banks, credit unions, those sorts of things. And I guess I'm curious, since we haven't really broken that down much, are the questions that some of those institutions on that end asking themselves significantly different from the ones that some of the larger institutions are asking themselves? And anyone who wants to take that up would be great.
So I do think there's a challenge with geography, right? If a bank is a small footprint and they're a small market and a small footprint, they can be limited in how they can sort of transition their lending book over a period of time away from their base. So I think that's where industry working groups are going to be important. I think that there will be new financing vehicles. Green bonds are going to be a way to help diversify out of some industries, and then helping your clients transition. Repeating on my last comment, I think is going to be really important for firms that are tied to a particular market or geography. Obviously, bigger firms, bigger geographic footprints, they can pick and choose a little bit more. So it's certainly something that can impact smaller community banks in a way that other banks have more flexibility. And I do think that there is a recognition in Washington that that's an issue that needs to be dealt with. But again, this is one where communicating early, thinking about it proactively, and not just waiting for the solution is going to be important.
Yeah, it's interesting. Regulators often talk about the idea of proportionality in regulations, and that's where the expectations that they might have for a larger, more complex firm would be different than those that they have for smaller firms. But proportionality when it comes to climate is something that I think regulators are still thinking through. It's, as Jeremiah said, it's in certain geographic areas, it's probably going to be more important that sea level is rising by a few inches than in other areas. And that really does depend on the footprint. And I hate to be too much the quant talk about data, but to go back to it, I think you do need to know in a fairly granular detail about the bank's exposures, both geographic and sectorally, and then have tools that take advantage of that. I think for smaller institutions, bigger institutions always have the advantage that they can put more resources into this, and that it pays off for them to, to do a lot of modeling of their own. I think smaller institutions are probably going to be looking for tools that are out there that they can use to try to evaluate their portfolios. And that probably makes sense for them. And probably, we don't know what the proportionality approaches will look like at the regulators, but it'll probably be aligned with what regulators are going to be looking at those smaller banks to be doing. Mm-hmm. That's the way what I'm sensing.
Sure. It makes a lot of sense. Again, we're making to the halfway part. I want to. We do have a few questions. It looks like that have come in. So I definitely want to go ahead and address them and not hog up all the time with my questions. So let's take a look. And some of them are directed, but again, I think if others want to answer them and chime in and add theirs, I think that will be perfectly fine and really help the conversation. So I'm going to go ahead and take a look at this first question that's come up, and this one is directed to you, Bruce. Will regulators expect banks to have their own climate models to generate scenarios? We've talked a little bit about what the banks need to do on their own, what they need to be doing first. Is this something that an expectation that you believe regulators are going to have?
Interesting question, David. It follows, I think, right from the comments that Mark and Jeremiah just made. I think for larger institutions, there's no question in my mind that the regulators will expect and boards will expect management teams to have the ability to model different scenarios, looking out over a fairly long time horizon, which I think is going to be a real challenge. Typically, we look at stress testing over 9 quarters or 12 quarters, whatever, but some of the implications of climate change are longer dated. When it comes to smaller institutions, it may well end up being a combination of models that are available from external service providers, as well as perhaps more subjective and qualitative work done in those institutions looking at individual borrowers that may not easily fit into, they may not have the capability to model on that basis. So I think it's kind of going to run the gamut, and I think there'll be a lot of techniques developed by the industry, and I hope shared as best practices within the industry and via the regulatory community. Mm-hmm. Mm-hmm. But I go back to Jeremiah's comment earlier. Banks are already making some of these decisions, and it's now how to add a more disciplined framework around that is well understood by all employees and ultimately by the bank's clients.
Any other thoughts on regulator expectations for banks?
I guess I just might add, I'm not completely sure on the question whether, one of the things in mind might have been whether banks should be trying to guess what the climate change will look like, to come up with scenarios of how the climate is changing and rather than how it impacts their business. And I think I'd say probably there are enough sources of climate scenarios out there that that banks can choose between, that they probably can rely on what's out there. But then, that's where how they translate that into the impact on their business is where they really need to do more thinking. And that's where I think, as Bruce was saying, it kind of probably depends somewhat on the regulatory expectations will depend quite a bit on the nature of the institution, on how complex it is and what kinds of risks it's running.
Mm-hmm. Yeah, and I would also think that the point that you made earlier, that some of you made earlier, about the way that climate risk can be sort of disaggregated into specific risks to specific bank operations and things like that. I just think that's an incredible, valuable way, certainly, to think about it, and glad to hear that that's how a lot of them are actually approaching it, because it definitely seems a very constructive way to deal with such a massive, potentially overwhelming topic. Let's take a look here and see if we got some other questions that have come through. Let's see, another one on regulators. Let's see, this one is directed toward you, Mark, but again, I'm happy to have everyone take a shot at it. Will regulators start using capital or reserve requirements or other tools to push banks to reduce involvement in carbon-intensive business activities? We've sort of talked about this just a little bit. I wonder, Mark, if you could maybe just address it in terms of coercive aspects or ways that these relationships might move forward in a constructive way.
Well, I'm going to be very interested to hear what Bruce and Jeremiah have to say about this one too. I think, if you look at the general attitude of regulators, and I'm most familiar with U.S. regulators, they don't tend to use regulation to push banks in particular directions, whether we're talking about capital requirements or reserve requirements or other things. Now, there are exceptions to that. I think some of what's been done in commercial real estate might have been to create particular incentives at times, although that's debatable, I guess. Depending on who you listen to, some of the discussion about counter-cyclical capital buffers, could be viewed as trying to incentivize particular things for banks. But I think my general sense is that that regulators will be reluctant to do this when it comes to climate. And I will mention one thing that the audience, for the audience, if they haven't seen it, there was a recent speech by the chair of the Basel Committee. And I think it was June, first few days of June. And it was quite good. And one of the specific topics that he took up was that he thought there would be pressure for regulators to try to incentivize particular greening behavior by banks. And he kind of pushed back against that and said, that's not what we're going to do for the international regulatory community. What we're going to do is assess the risks and then make sure that regulations, like capital regulations, are aligned with the risks, taking into account the impact of climate. And I think that's a pretty good gauge of how regulators are, at least would like to think about this internationally. Now, they may face political pressure. Certainly, there's always discussion in politics about trying to push in other directions, and regulators have some power to push back against that, but it's a tension. So I think we don't know yet, I guess would be my answer. My answer would be regulators are probably overall reluctant to use regulations to try to incentivize particular behavior, but it's not out of the question. I know Bruce and Jeremiah, tell me, maybe I got that wrong. You guys would have a different perspective.
No, I think, again, speaking for U.S. regulators, great reluctance to dictate industries, companies, et cetera, that banks can or cannot lend to or should not lend to. But I think the emphasis on proper risk assessment and pricing of that risk is always high on the agenda for any supervisor. And I think the supervisors will press on that aspect of risk. Both how you're risk rating a client, how you're pricing for it, and ultimately that'll drive the risk weight RWA calculations and the capital. So I think it can come through right down at the the supervisory team level as they go in and evaluate a bank, and through things like the shared national credit exam, looking at large syndicated credits in terms of the structure of those and the risk rating of those assets. Jeremiah, what do you think?
I think from my experience, I would agree that regulators are reluctant to get into the game of driving behavior from capital charges. Now, I will say, I do think there are examples where that may have happened in the past number of years. Usually, it's pressure to reduce weights in certain areas, and it can come from the banking industry, and it can come from Congress, depending upon what's happening. This, to me, feels like one that I could see pressure coming into the supervisory community over time that pushes capital charges up in areas. It could be tough to legislate, and so you could see the soft power of letters, hearings, FSOC meetings coordination and capital charges going up. So, I'm not predicting that is going to happen, but it wouldn't shock me in this area if that's where this ends up at some point.
Absolutely. And I mentioned another point that I might want to touch on maybe toward the very end, if we get a chance, that Bruce hinted at, and that's that sort of public pressure, non-legislative, but just popular pressure, how that can work in different places and how that can lead to some of the things that you're talking about, Jeremiah, where perhaps potentially an impatience maybe develops. And folks feel like there needs to be something that stirs the pot a bit. But before addressing that, I did want to make sure that our attendees' questions do get answered. We do have time. If you do have a question, to go ahead and send it to us using the Ask a Question button. Want to make sure that we take care of everybody who came to the webinar here. But here's one, and this one is directed to you. This is right up your alley, Mark. How can models for climate scenario analysis be validated when there's no meaningful historical data?
Wow, yeah, that's one of my favorite questions. I think. I've heard this a bit, that actually it's a tendency to people to throw up their hands and walk away and say, well, there's no data, we can't validate these models, so how can we use them? I actually think that is, well, first of all, it's not accurate to say there's no data. It's still emerging. There's data out there. But I think it's important to go back to what validation it means and what its purpose is in modeling. Ultimately, validation is about determining that models are fit for purpose and for the business application. If you go back to look, say at the U.S. supervisory guidance on model risk management, it says validation isn't just about back testing or formal statistical tests. There are a lot of other things that you have to do to determine that models are fit for purpose, and you can do those with models for climate risk, even if there's limited data for formal testing. So, just to give a couple of examples. Besides some obvious things like you have to make sure that data quality is there and data is appropriate for the models, the development process for models should be a key focus in validation. What was the scientific and research literature that was drawn on to be able to come up with the models in the first place? Who did that? Were they competent? How was it reviewed? Some of those things. Then what the supervisory guidance refers to as benchmarking, which is using alternative models and comparing the results and learning from the differences or the convergence. So if you, just to give it a concrete example, you do two models of the climate process drawing from different approaches, you compare the results. If they're very similar, that gives you more confidence that you're right. If they're dissimilar, you're not wrong, but it's less confidence. So all of that is oriented toward ultimately giving you a degree of confidence that whatever methods or models are being used are fit for the purpose for which they're being used. And those are the kinds of tools. You have to lean more on those kinds of tools rather than on formal statistical tests at this point in time when it comes to validating models that are used in the area of climate. So I think over time, the balance will shift. There will be more data. There will be more opportunity for formal testing. And when that data is available, absolutely, that should be done. But it's not appropriate right now to just say, throw up your hands, we can't do validation, we can't do back testing, because I think that's just wrong. I think that's a misunderstanding of the purpose of validation and what it actually means. And it's not consistent with regulatory expectations, at least as expressed in the U.S. model risk guidance.
Mm-hmm. Yeah, I think that makes a lot of sense. And I do think that at least in some areas, maybe more in the areas of discussion about this than the actual participants and banks and so forth, there is that sort of why we need to go through this, we can't do this kind of thing. We don't have the tools, we don't have the resources. And I think it also, to me, echoes a little bit the conversation or the comments that you made about the difference between scenario analysis and stress test. That there's things that can be learned in a scenario analysis that might not be as statistically definitive as we might like in some other context, but that doesn't mean that important information can't be derived from it all the same. And I think it's a similar sort of thing. And also, quite frankly, the idea of whether or not, for lack of a better term, punitive regulations would play a role. And the sense that I'm getting from you all, and please correct me if I'm wrong, is the nature of the problem is such that even where that sort of thing would be, there'd be a disinclination to it as there is in the United States, there's perhaps even more of a disinclination to it, given the type of thing that we're dealing with here with climate compared to some sort of tax structure or some sort of KYC type of terrorist financing sort of thing, where it's a little bit more exacting. Would you say that that's accurate?
No, I certainly I would agree with that. I think that's the stage that we're at. Everyone is learning more right now. The regulators are learning, the banks are learning, and it's not the case. I mean, the expectations have to be tempered to reflect that. And frankly, all the decisions should be done carefully, should recognize that there's a lot of uncertainty. So what would be bad would be to set a course of action that's irreversible at this point. Rather, we should do it, be as well informed as we can by the analysis that we can do, but we should recognize the uncertainty and not lock ourselves into something that we might regret later. That's hard to do in practice, maybe easier to state in principle.
Often is the case.
I think there's another aspect too that may not be, we haven't talked much about, and that is the requirements for disclosures that are, again, in early days, but evolving pretty quickly. And that is another way that governmental agencies, whether that be the SEC or one of our former organizations, can apply pressure by full disclosure, and investors and others will start to look and compare that data across banks. Number one, to see the relative comparison. Number two, to say, is this bank really living up to its beautiful mission and strategy statement or not? And there you get a little bit of both investor pressure, regulatory pressure, and public opinion that can drive some of the risk and strategic decisions of a given bank.
I agree with that, Bruce. I think,
please.
Yeah, take the scenario analysis example, implementing a scenario over a long period of time, and then translating that into economic output along the way, and then taking that down to specific credits is challenging right now. And I think one of the impediments to having a really good scenario analysis is that there's mitigation that will take place either through changes in behavior or consumer preferences, whatever they may be. But the disclosure that Bruce talked about, I think will come quickly. And those that disclose and perform versus those that disclose and don't perform versus those that can't even disclose at all will be bucketed. And I think we could see all three of those. And being in the last bucket is not going to be comfortable for long for banks that have constituencies, not just supervisors, but investors or borrowers or just people who live in the community. So I think that this is an area where you could almost see the banking supervisors helping by creating that standardization, that taxonomy, whatever it might be, that will enable everybody something to strive for in terms of, all right, these are the areas that we have to meet for disclosure purposes, and then we'll be measured by someone, whether it's our board, our shareholders, our borrowers, to see how we're doing.
Arguably measured by all of them. It seems might be the case.
Yes.
I think that was one of the points. Yeah, that you brought up, that all of you have brought up, that there's so many different players with stakes in this particular, all of us really, but certainly in this particular conversation about how to deal with some of these sorts of changes. And I think it's going to be very gratifying for folks who listen to it on the recorded version. This will be available for folks if they wanted to take another look at it later, or if they were not able to see the entire presentation. So as they reflect, just on the relative, from my point of view, just maturity that seems to be taken to this, that there have certainly been times when regulations have come faster. There's been times when resistance has been more fierce. And one of the things, at least it seems at this point, is that there is a certain understanding of the general task that needs to be done. And then there's just a lot of feeling around to figure out what are some of the most productive ways, reversible productive ways if necessary, that we can start to make some of the changes that we think we might need in order to meet these challenges. Taking a look, it looks like we've got most of the questions touched. We are coming up to the top of the hour, so I'm going to apologize if we're not able to get to all of your questions today. I do think we've covered quite a bit of ground on this topic that definitely, as you can tell, could be the source of a number of different conversations and webinars about a lot of these different topics. So I thought perhaps just by way of closing, if there was any final takeaway that you thought that you'd like folks, again, a lot of the people who participate in our webinars do come from smaller institutions, but a lot of them also are from larger institutions and from fintechs, whose job essentially is to come up with solutions to help financial institutions do some of the things that they need to do. I wonder if there are any maybe final takeaways that you'd like to offer for any of those players as they look at ways of dealing with some of these challenges.
Well, maybe just from where we started, that all three of us on the screen have been around the regulatory space for a while, and I think it's fair to say that there is real momentum in this area. You're seeing it in the executive branch, you're seeing the legislative branch, you're seeing it in the U.S. banking agencies, you're seeing it in the SEC, the CFTC commissions. You're seeing it the global coordination bodies. So I think that there are some that will want to wait, as I think was referenced on the call earlier, or some who may not agree with the policy direction. I guess my view is I'm not sure it matters whether or not someone agrees or whether or not they think it should happen or will happen. I think in my considered judgment, it's happening based on what I'm seeing. And so I think being prepared to meet the challenge is really important for running an institution, for running risk, for running origination. It's hard to ignore this topic, hard to hide from it, really, if you're in any part of a bank in credit or risk management. So that would be my sort of comment on the topic for the hour.
Excellent.
Yeah, I think that's a great summary, Jeremiah. It's whether you agree or don't agree, it needs to feature in conversations at all levels within a banking organization, from the origination through risk to the board. It is happening, and I think it's going to accelerate, not slow down.
And I of course agree with both of the other panelists. I would say the important thing that's emerging for banks is this is part of good credit risk management. And so given the impact this is going to have on credit risk, you can't really be doing it without starting to think about climate now. So banks should be moving to incorporate that into their risk management.
Excellent point. And I think it just underscores the one point I think you've all really emphasized, that banks are in the business of managing risk. This is something that they can do. It's just a matter of getting the assistance they need, the tools they need. And as you also, I think, underscored, the leadership to make sure that these things happen, I think is also very, very important. I'm afraid that's about all the time that we have. We're coming up quickly on the top of the hour. I want to thank all of our panelists for fascinating conversation on arguably one of the most important issues facing all of us, and certainly a key issue facing financial institutions as well, the challenge of climate change. As I mentioned, the presentation will be available in the days to come for those who've registered for the webinar. So if you'd like to revisit it, if you'd like to take up some of the other conversation, please feel free to do so. Again, we'll have that up on the blog in the days to come. So once again, my thanks to our panelists, to Mark, Bruce, and Jeremiah. Thank you very much. And thank you to our attendees for joining our latest Finovate webinar. We look forward to seeing you at our next one. Thanks again.
Thank you.
Thank you.